Uber has this network of people that go out and provide a service, right? And then Uber captures some of the fees, and the people who provide the service capture some of the fees. And there's this tension between the two. And, we've seen that play out, right? Where drivers want more money. And, so LPs and uni token holders, who's collectively the company, are going to have to play this game of, how much do we want? Because ultimately, if the uni token doesn't accrue any fees and Uniswap, as a collective doesn't accrue any fees, then, on some level, it's not really sustainable what they're doing.
All right, everyone. Welcome back to another episode of Empire. Santi is sitting this one out. We got my co-founder, Mike Ippolito, joining us. And then we are joined by the semi-benevolent dictator, or should I say former semi-benevolent dictator of Synthetix. Kain, I don't know what you are describing yourself as these days, but either way, welcome to Empire, my friend.
Yeah, thanks so much. I guess it depends on who you ask, whether it's former or current.
But so the former or current is who you ask, but semi-benevolent 100%. Dictator is true though, yes?
I think that's fair. Yeah.
Nice. How'd you get the nickname?
I used to be just like the dictator, right? And not even benevolent. And then I think, we got to a point where we were like, okay, we need to decentralize things and give up power to the community. And, we started that process. And I think people were like, wait a second, you're very aggressively kind of advocating for certain positions and arguing with people. This is not necessarily what we were expecting, giving up power. And my argument was, well, if you give up power and you create a process where anyone can, have a voice, right, then I should be able to have my own voice and my own opinions and my own perspective. And that's, gone fairly well, I think. But there's some people who sometimes get a bit annoyed about how vocal I am about certain things.
I think things have gone all right though. So, well, we've come a long way since the dictator days of 2018 and 2019 and depths of the bear market. You have this idea about just different metrics that matter in different bull markets, right? So if you look at ICOs, the metric that 2017 and just the market ripping then, the metric that mattered was how much money can you raise, right? Then it's DeFi summer 2020. The number that matters is really total value locked, is TVL. And I've heard you talk about the metric that will matter. It doesn't maybe matter as much now, but you think it will matter, and we can maybe meme this into existence. Is fees, right? So I'd love to just maybe kick off this conversation starting with that idea.
Yeah, it's interesting. Actually, I had a pretty prominent person in my DMs last night in the crypto space who was like, "Oh, Token Terminal kind of shows you guys are throwing off quite a lot of fees. What's going on there?" And we got into a bit of a discussion about it. And, it's interesting because I think TVL, sounds like a metric that is, I guess, fairly fungible, right? Like TVL and Curve and TVL and Synthetix. But the reality is that TVL, is a very blanket term for a lot of different things, right? There's things, there's TVL that's in staking, single-sided staking pools, which, is one thing. This, stablecoin pools have TVL. So when you look at TVL, it's not like this kind of homogenous thing, right? I think. And that makes it easy to game. Because if you can boost cheap TVL, which is low risk, right, you can make things look better than they are. And I think that there were a lot of those kind of games that were played back in the TVL days. And then over time people get a bit more sophisticated, and they're like, okay, we can see that this protocol has certain things, and I think we'll see that play out with fees as well. Because when you look at fees for Synthetix, let's say, right, and even if you compare it to Uniswap. So Uniswap generates the most fees of any DeFi protocol, right, by a pretty significant margin. But it doesn't pay any fees to token holders, right? It doesn't pay any fees to the protocol. It only pays fees to liquidity providers, which is fine. Liquidity providers are doing a thing. Whether and when the fee switch gets switched on will be a pretty significant change, right? Because once the fee switch is on, then you as a uni token holder are going to get some kind of fee yield, and you can do calculation and what have you. So even within those two protocols that are kind of in the top 10, Synthetix is very different, right? Because your kind of risk profile and risk adjusted return is different. And the same thing goes for Uniswap as well. Like if you're an LP in, a stablecoin pool, as long as it's not UST, you're probably okay, right? If you're an LP in like WETH, some random shitcoin, well then, your IL risk is going to be very high, right? So like there's even within, different kind of fee metrics, the risk adjusted return is very different. So I think that this is something that, collectively you have to get more sophisticated about. But luckily, I think, TradFi has spent a lot of time working out, how to calculate kind of, risk adjusted returns and things like that. So hopefully we can take some of the good stuff of that and translate it to DeFi.
Kain, I have a question for you. What do you think will be the determining factors for protocols that are capable of commanding fees versus ones that don't or aren't capable of commanding those fees?
Yeah, I mean, I think we still don't have a good kind of frameworks for even reasoning about this yet, because every protocol is kind of so different and has like all of these idiosyncratic kind of challenges, right? In terms of like how you think about fees and how they're earned and who earns them and where do they go and how they're distributed, all of that stuff. So I think my sense is that, like, again, if you look at something like Uniswap, if they switch on fees, how much of the fee yield do you need to transfer to Uni token holders? Because it's a zero-sum game, right? You're taking fees from LPs. How impactful is that to LPs that are trying to do the thing, right? There's a service that's being provided, which is liquidity, right? And you're paying the people who are providing the service 100% of the revenue, right? It's an interesting concept. It's very different to a business, right? Like a business, kind of turns up, provides a service, and captures 100% of, it's probably a closer analogy is something like an Uber, right? So, Uber has this network of people that go out and provide a service, right? And then Uber captures some of the fees, and the people who provide the service capture some of the fees. And there's this tension between the two. And, we've seen that play out, right? Where drivers want more money. And, so LPs and Uni token holders, who's collectively the company, are going to have to play this game of, how much do we want? Because ultimately, if the Uni token doesn't accrue any fees and Uniswap, as a collective doesn't accrue any fees, then, on some level, it's not really sustainable what they're doing.
But why, Kain, why now? Like, so you say it's not sustainable. And I think what you're getting at is like, if all we're doing, if we're not actually giving, if we don't have this nice cycle and this nice like feedback loop here, and we're not actually spitting back cash flows, then like, what are we all almost doing here? But if you look at Uber's been around for 12, 13 years, founded in like 2009, 2010. I feel like, I mean, I'm in Manhattan right now. It used to be $5 rides anywhere in Manhattan. Now it's 40, 50, $60, but only in the last like year or two did that change really happen. So, and like when you look at things like Uniswap, it's like really only have they had a lot of volume for, let's call it 2 years. So it's like, why can't we just almost keep subsidizing this stuff in the way that like Uber and Airbnb and Lyft and all of them subsidized it for nearly a decade?
So I think, at a fundamental level, it's okay to subsidize things to bootstrap them, right? I think we took the idea of like blitz scaling and subsidizing and whatever to a degree that was probably unsustainable, right? And how did we do that? Well, we had this crazy, asset bubble based on money printing that was inflated. And so VCs had, infinite amounts of money to dump into, companies to allow them to unsustainably grow or unsustainably, subsidize services, right? Until they didn't. Right? And I think now we're kind of seeing the end of that party. So, ultimately then the question is, okay, at what point can a business like Uber kind of become sustainable, right? And at what point should it become sustainable? My view is like you realistically should try and become as sustainable as you can as soon as you can, right? Obviously, there's definitely a payoff curve there, right? And you don't want to do it too early because you could have scaled much larger. But the reality is, I think Uber could have absolutely switched that if they didn't have VCs pouring money into them. They absolutely could have. The Vision Fund alone, right, subsidized billions of dollars worth of low cost rides, right? And so like when you ask the question of DeFi, like DeFi is supposed to be more efficient right? It's supposed to be less overheads, less, all this stuff. If Uniswap and Synthetix and Aave and Compound have been around for 3, 4, 5 years in some cases, right? Can't get to a point where we start to become sustainable. I'm not saying we have to be 100% sustainable today, but like we start that process, then we're kind of just playing the same game, right? That we've seen a bunch of SaaS companies and other companies play for the last 10 years, which I just don't think we need to play anymore. I think we really can get to a point where, so like a company that's starting today or a project that's starting today, go nuts, subsidize, raise money, whatever. Uniswap and Synthetix and, the blue chip DeFis that have been around for 4 years, like we kind of got to get serious now.
Do you think the ability to fork, just the fact that everything's open source code in crypto is different? It's like, because the example of Uber, right? Basically, the VC model is just fund a monopoly, right? What you want to do is you want to subsidize. At the end of the day, what you want is a monopoly, so that finally, when you do jack the prices back up, no one's left to compete with you. But in crypto, you have the option to fork, right? So do you think that's a fundamentally different dynamic that limits the ability to compete with that same strategy?
So it's interesting because like this idea of forking and fees and everything was like a huge theoretical discussion topic during the last bear market, right? Because we were all bored and we needed to come up with something to argue about.
Just
right?
wanted to talk about shit.
Yeah, we had to talk about some dumb thing, right? So like I think that like was the topic for like every Thursday for like a year or something. It's like, no, but you can't do this because it'll get forked or whatever. I don't think, and again, I might be wrong, right? Even maybe that like anti-Justin Sun fork, I can't remember the name of the protocol, but like, I don't know how that's going now. The one that forked and took all his tokens away. I'm drawing a blank on the name of it, but it was a project that had been around for like 5 years. Justin Sun bought it and took it over, and like I don't know how that fork is going, right? Like, maybe fine, but there's not many good examples out there of protocols that have been forked, right? I think the expected effort of maintaining a protocol that people had back in 2017, 2018, that like, oh, it's just some code, you deploy it, then walk away, has been kind of invalidated, right? Like you need a community, you need people who are, maybe they're not doing this in like a centralized fashion. Maybe it's this kind of, as I said, with Uniswap, like a loose collective of people that's advocating and educating, whatever. But if you remove that, the momentum drops significantly. I think is my view. So I think the idea of forking to remove fees is more of a theoretical construct than it is like a practical concern.
Do you think there's this is kind of multi-coins theory, so I'm gonna try to paraphrase basically, but I kind of do like this. Yeah, I know. But the idea of like managing risk as an ability to fork your protocol. So like Uniswap, with like an exchange model, you're not managing any financial risk there, right? You're just connecting buyers and sellers. So the idea is that you could fork an exchange, right, and just offer higher, subsidies essentially on this new fork, and you might get a bunch of mercenary liquidity, like. And that there's less of a moat, whereas something like Maker or something like that, really what the moat is there is that you're underwriting risk. And it's like, okay, I can fork Maker tomorrow, but like, are all of these units going to come along with me and like maintain all of that competence and that balance sheet? Like probably less so. So I'm wondering if even within, because I tend to agree with you. It's like, I don't think you can just keep forking the nth iteration of a thing and expect people to follow. But I wonder if even within different classes of DeFi protocol, maybe like managing a balance sheet or managing some risk yourself is also more of a moat.
I actually think there are a lot more moats than people realize, right? And my assumption around that argument is that Kyle had funded some Maker competitor the day before and was coming out with some PsyOps campaign to justify the investment or whatever. But like I think.
What do you think about multi-coin, Kain?
I'll actually say this, right? Like I will and I don't know if I've said this publicly because I've had a number of debates with Kyle and kind of had some interactions with them on Twitter. I've actually recommended them to a number of funds of funds. For whatever reason, they somehow got me on their Rolodex, and they ping me every once in a while to be like, "Hey, we're thinking about making an investment into this crypto hedge fund or this one or whatever. What do you think?" And I've actually never not recommended multicoin because I think that multicoin is super opinionated. I think they're wrong, but if you want exposure to like certain areas of crypto, if you just go down like this ETH maxi path, if you're a fund, right, you want exposure to people that are kind of maybe a bit counterintuitive in their thinking, whatever. So like, I actually think multi-coin is fine, but tactically, I don't agree with some of the things that they do. But
not to go on a random tangent about funds, Kain. But who do you think who someone's like, I'm raising capital for from 3 funds, or I'm allocating to 3 funds. Who are like the best? Who are your favorite funds in crypto right now?
I mean, obviously, got a lot of love for a framework, right? They
sure.
kind of turned up in the bear market. We're one of the first funds to really get behind Synthetix, like post pivot and everything. So, we obviously have grown up a lot since then, and are not as connected to them as we were back in the day. But I still, I actually had Michael on my mentorship program last week. So we keep in touch pretty regularly. So framework, I think, are great. And then from there, it kind of depends on what you're doing and who you like. I don't want to go and shill some of the funds that I'm an LP in, but like realistically, if you're super early stage, there's some funds that are maybe too big for you. You want people that are more like angels. So like for early stage, like a company or a project raising their first round, my view is always like try and get as many angels in as you can, and then find like a fund that you think is high conviction in that space, and it will kind of come with you on the journey.
Let's get back to Mike's. I want to get your answer to Mike's multi-coin question though.
Oh, sorry. What was the question? I got
it was just about like just within different models, right? Like the ability, like managing risk, like kind of balance sheet risk, and having like just moats around forkability. I guess.
Yeah. Like I think the immediate answer is my kind of take on it, that like I think there are a lot more moats out there than people realize, right? Like people think that something is as simple as just deploy code, walk away. I don't think that even the simplest DeFi protocol really works like that, because you're still operating in a competitive marketplace, and there are a lot of alternatives to do the same thing. And absent, all of the kind of structure that you need around, kind of information dissemination and education and all those sorts of things, like you can deploy code and walk away, and it can just kind of sit there. But if you don't have the infrastructure around it, it's going to be really hard to scale it up.
That aligns with how I like. That makes sense to me. That just aligns with like how I think companies are built. And I'm like, okay, if you just like, let's take Blockworks for example. If you just copy pasted like our website, every single piece of content on the site, all of this, if you copy pasted this exact interview and put it out on a different RSS feed, I'm like, well, there's no marketing. Like there are no users.
And it goes stale really quickly, right? Like,
it goes stale.
There's no strategy, and
Agreed. So and I just think that's broadly true for almost everything, right? Like, if you have 3 things that are doing the same thing, 2 of them are kind of out there, like advocating, educating, doing all of these things to make themselves accessible and build awareness. And one of them is not, even if it's the same code, like the one that's not is just going to kind of disappear into obscurity.
Although it doesn't totally disappear, does it? It usually goes down to like, it retains like 5% of the value of the successful fork.
Yeah, agreed. 100%, which is weird. I mean, that speaks to like crypto market inefficiency more than like anything, right? Like I think, tokens never go to 0, right? They go to like 0.000001 or something.
Okay, so I thought that as well. And actually our newsletter writer, Byron, wrote a newsletter on this, and we got a response. I'm going to protect the names of the units, but I thought it was a very interesting observation, which is one answer to the mystery, which is why do these forks retain any values, like the Ethereum Classic or the Bitcoin Cash or whatever, is that nobody wants to short them and the owners don't want to sell down there. It's a common thing in very cheap stocks. A company is very clearly bankrupt, but the stocks trades at 150 at a decent valuation because nobody wants to short it, and the holders just can't be bothered to sell when it's down 95%. So it's a kind of standard stable disequilibrium, if you will, which actually I thought was like the best explanation for why these things still exist.
That makes sense. Yeah. Like I guess it's just a question of why is that equilibrium or disequilibrium so high in many cases, right? Like it seems like there's an opportunity, and I think that kind of speaks to the inefficiency. Like, penny stocks trading at like a $3 million, valuation or whatever, fine. Weird zombie networks that are trading at like $1 billion valuation, like that seems like they're, but I agree, like there is no incentive to short them because how many times have people gotten short, wrecked shorting some scam or whatever, right? Like, it's dangerous to short a crypto.
Okay, now I want to get your take. We're 2 years removed from DeFi summer, and two of the biggest things to come out of that was like, you had Uniswap kind of kicked off this airdrop season, then you had Compound kicked off liquidity mining. We're 2 years almost removed from that. A lot of folks have talked about copy pasta. Like a lot of folks have kind of just dove into liquidity mining and airdrops. And I think now a lot of folks are reflecting, saying like, well, was that actually good capital coming in? It's probably more like mercenary capital coming in, and then they're quick to leave. What are your thoughts now that you've had some time to reflect on liquidity mining, airdrops, all these different incentives that were really designed to increase TVL?
I think that what works in a bear market doesn't necessarily work in a bull market, right? And DeFi summer really happened in a bear market, right? Like it was kind of, one of the catalysts, I think, that, one of the things that had momentum coming out of the last bear market. And if you think about, what yield farming did, and, again, like yield farming is a very blanket term, right? There's a lot of different things. Like you could include Synthetix inflation, right? And realistically, Synthetix inflation, going from a fixed supply token to an inflationary token saved the project, right? Were it not for that, there was no way that people would have paid attention to Synthetix, right? Like that yield from staking was what kind of drove the activity. And then following on from that, yield farming within like Uniswap to create liquidity, in like entry and exit liquidity for SUSD and the other synths, right, was another thing that kind of drove awareness. So my view is that the yield farming campaigns that Synthetix did were the things that allowed it to survive, right? Like when we talk about, kind of unsustainable incentives to bootstrap, like we kind of got to the bottom, right, in early 2019, and then looked around and said, okay, like if we're going to pull this thing out, like we need to, of the tailspin, this death spiral that it's in, right? We're going to need to do something kind of, pretty crazy, right? And so that was where we came up with some of these like yield farming ideas to kind of drive that. So I do think that like in the right environment, it can work. Obviously, sometimes it doesn't go well, but like even looking at Compound, right? Like, and a lot of people would say like they massively overpaid for liquidity or whatever. They were juicing up TVL, which, at the time was the metric that everyone wanted to pay attention to. But I think if you went around and asked the average person who was still in crypto in the bear market, right, 3 months before Compound launched their token and started yield farming, maybe a third of them would have known about Compound. Maybe.
I agree with that.
Like, and then by day 3 of Compound's, yield farming thing, 100% of people knew about Compound. And when I say like, crypto people, I mean like even like Bitcoin maxis and stuff, right? That are like in their own little bubble off here. Like if you asked, Samson Mao, he'd be like, yeah, I know about Compound. I hate it, but like, he knows about it, right?
Yeah.
And so I do think that like when you factor in, even though they gave away a lot of value, right? And they probably overpaid and they could have, it's hard to get that sweet spot right, but like they could have definitely given a lot less yield and gotten the same result. But they demonstrated that you can go from, like awareness, market penetration, whatever you want to call it, of 20% of all crypto to 100% in the space of like 5 days if you have like significantly, high enough yield, right? And so I do think that like, that advertising, if you went out and did like any kind of traditional advertising campaign or whatever, try and build that level of awareness, would cost you, who knows, tens of millions, hundreds of millions of dollars, right, to get that level of kind of market awareness. So it can work.
I don't even think it would have worked.
I
don't even think you could have spent infinite dollars.
Yeah.
It wouldn't have worked.
You're probably right.
Yeah.
You're probably right. And so, in that regard, you say, well, obviously it was a success, right? Could it have been cheaper? Absolutely. But, the flip side of that is if it was too much cheaper, maybe it doesn't work at all, right? Like there's some tipping point and you don't know, before you start what that's going to be. So I look at that. The flip side is I look at airdrops, right? And airdrops, thankfully, are not the responsibility of DeFi. Airdrops started back in the ICO days as a way of like offsetting private sales, as throwing a bone to the masses or whatever, whatever the kind of tactical move was there. So, we inherited airdrops, and then I think most of the early DeFi projects did airdrops. It was probably Uniswap that like revived the airdrop concept, right?
Yeah.
Like doing it with a token after they'd raised a bunch of money and deployed a bunch of stuff. Like that was a different kind of conceptual airdrop. But I think today my view of airdrops is that they are a failure versus yield farming. Like, I think if you compare those two things, I think yield farming still has value in the right kind of yield, and especially in a bear market, I think yield farming can work effectively. I think that airdrops are a failure.
Let me try to push back, which is airdrops now are you see activity happening pre-airdrop and even pre-token on things, because it's like airdrops might be a failure for the project, but they're actually a net benefit for the space because they get people to try new protocols and new projects and try new products. So like there are products that are like, their products are like pretty crappy, to be honest, and they're pre-token, but like people go and use them and they can get like their first 10,000 users because there's because you have these like airdrop farmers and there's an expectation that they might get an airdrop. And then for like 1 out of 50 of the product's actually pretty good. So then they go and share it and it goes viral. And you kind of see this with like pseudo swap. Maybe you could say this is happening right now.
Yeah, again, like information dissemination in crypto is very hard, right? Like it's super inefficient. I was talking to one of my mentor projects like a couple of days ago, and I was like, it doesn't matter how good of a thing you do, right? Like, it's the equivalent of like $100 bill, in the middle of Times Square or something like that, right? Like, that $100 bill in crypto can stay there for like weeks or months, right? Because there's just money everywhere. It's chaotic. Like, no one believes anything that anyone says. Like, there's all this like disinformation and stuff. And so, when you look at like market efficiency and like the efficiency of information flows, it's really, really weak in crypto, right? The amount of times I've seen something where like some project does something, it's really successful, and it takes like 3 months or 6 months before anyone even pays attention to it. Yield farming and airdrops are a way of kind of short circuiting that, right? I think that was like the market solution to like, how do I get people to pay attention to me today versus in like 6 months that it would take from like normal, tactics of kind of going on podcasts or, writing blog posts or whatever it was that people were doing. So that's fine. But then when you think, okay, so I've got tokens and I'm going to use those tokens to incentivize people to pay attention to me, right? And you think about what are some of the kind of, approaches that I could take. When I look at like the kind of continuum of different approaches, like a pure airdrop to just a bunch of random people, right? Which is the old days. Like, you literally sign a form and you get tokens, right? Like that kind of, end of the spectrum to me is a failure. As you come closer to like, you have to do certain things, and it starts to look more like yield farming. Like your point of like, there are people using the protocol to qualify for an airdrop. Like that's almost like, pre-yield farming sort of stuff.
Pre-yield farming.
Yeah, exactly. Yeah.
I have a question just in terms of, I had this debate actually with a friend, just like the expense. So like if you view yield farming as like a very expensive form of customer acquisition, like marketing, you could look at that and say, wow, that's like really expensive, but it's also not a cash expense, right? And a lot of these protocols, like very early stage, they don't necessarily have liquidity, right? Like look at what's happening right now with like Lido and Gitcoin, and they're all trying to diversify into stables, right? There's like a very limited ability to do that. So like I hear you on the ones, like you can look at the dollar, be like, you sold for what? How expensive was that? But like on the other hand, how readily was the actual cash available for that as well? Like, do you have a thought just on like just equity finance versus like actually converting to cash?
Look, there's no question, being able to like give people equity, right? Give people ownership in a protocol,
right.
Is not a cash expense, right? Like if you look at PayPal's,
right.
The original blitzscaling move was PayPal giving $10 to every person who signed up another person, right? Like this referral bonus. Now, okay, you can't give out free money unless you have KYC to like, anti-Sybil it, right? Like realistically, like, and even then I'm
right.
sure, they lost millions of dollars to like Sybil attacks or fraud or whatever like that, but they didn't care, right? Like it allowed them to scale up to a point where they became, critical to eBay's infrastructure and then that whole thing, right? So you look at some of these like startup stories of, early, like, Web 1 startups, right? Like, back in the like, ancient history days, right? This kind of thing has been going on, but if PayPal had the ability to give away PayPal equity, right? Now, on one hand, dollars are more powerful than equity, right? For a lot of people, because dollars are dollars, you can use them today, versus equity. But if there is an open market and a semi-liquid market for their equity, they're a good proxy for dollars, right? Like it might, cost more because whatever. So I think when you look at some of these tactics and what you can do, like, yes, it's absolutely beneficial that we are able to spend, non-cash consideration for attention, right? And to your point, I think about like markets, right? Like it is better for the market to have this mechanism, right? Because it drives attention to different things that otherwise wouldn't be able to get attention. And some of them are good and some of them are bad. My question about airdrops and, even like ignoring pure airdrops or whatever, is that you remove the need for any kind of conviction, right? So this is the thing that I have an issue with, right? Is that like yield farming required conviction. You had to put your own money into a contract that, it was probably staking rewards.sol, but like you had to put your money into some contract that someone had coded, and you needed to believe, and if you wanted like real yield, right, you might have to put like, hundreds of thousands of dollars, right? Like some people put like a meaningful amount of their assets into these yield farms, right? And it became this game of who's in there, and people would look at certain wallets and be like, oh, that wallet's in there, so this must be safe. They've vetted it, et cetera. And there was this game during DeFi summer of like which things are safe, which aren't safe, and what have you. But the reality is you needed conviction. So even if you're yield farming and then selling, you had some cost almost, right? Like there was a cost to you acquiring these tokens. And I think when you get free tokens just for doing a service or something like that, there's a lack of conviction, which I think could be rectified. I don't have necessarily the solution to this, but I think that removing the need for like some kind of conviction is a negative on the airdrop side.
Yeah. Everything that we're talking about is very B2C focused. So like yield farming, airdrops, these are ways to get users onto your protocol and onto your platform. I want to get your take on B2B, or like what feels like DAO to DAO, which feels like the next evolution of what's happening in DeFi. I was looking at some of the stuff going on with Synthetix. You guys have like SIP 267. It allows you guys to integrate directly into applications. I don't think this is official. I saw something on Twitter. It's like the Synthetix team is looking to create a direct integration with Aave for a direct deposit module. Reminds me of like what Maker feels very similar with, like to Maker's D3M with Aave, which obviously they're scaling that up with probably other protocols coming soon. What is the future of like DAO to DAO, and like is that where all of this goes, where you have like the base layer of these like OG like original DeFi protocols that are kind of using other newer DeFi applications as like the front end?
I think this kind of goes back to that like earlier point about moats, right? And people's assumptions about what would happen versus what actually transpired, which is that composability was supposed to just be this open permissionless thing, right? And like you just turn up and you've got this contract and you connect it, right? The reality is that just connecting two contracts is often not enough, right? And the reality is that even with composability, oftentimes in order for something to work, there needs to be some like engineering effort on both sides, right? Which now you're into like B2B kind of there's a whole thing right around like how you approach and negotiate and like deal with these things. And so I think we're seeing that where like most of the easy integrations, simple kind of purely permissionless integrations have been kind of have been done. Right. And that easily accessible stuff has been done. But the harder stuff, which required convincing the other community to make changes that you needed, that's like this next evolution, I think, in composability. But it's not permissionless composability the way that everyone imagined.
It's funny about that. Jason and I have talked a lot about like M&A and when is M&A coming to crypto, so to speak. One thing that's very funny is like if you consider moat like to be a big, community to be a big moat for crypto, like the number one reason why M&A fails is what's it like cultural differences, right? So it's just very interesting, and I'm curious to see how that all ends up playing out in crypto, frankly.
I think the biggest impediment to crypto M&A right now is the fact that like seigniorage whatever you want to call it, profits, or the ability to print your own money, make your own money, and the speculative premium, even in the bear market, that is applied to that is so outlandish that it really makes it hard for two communities to come together and merge, right? Like Synthetix has looked at this a number of times, right? Like, okay, you can look like the Rari Faye fiasco. I think there's other issues going on there, but like it's really hard to even get to a point where you can agree on what the value of the thing is when there's like this, tradable token that has a liquid-ish market that has this speculative premium attached to it that might be, orders of magnitude above the actual value of the thing that you're bringing in, right? And so that I think is going to be the biggest impediment until, some of these things kind of fail, and then maybe you see like acqui-hires and stuff like that might happen when people have kind of given up on the project and you're bringing an engineering team in or something. I think that to me feels like the first kind of wave of these things that might happen in the bear market, like teams that don't have runway, want some exit strategy, et cetera. But even then, I think if you were to go to the average project that maybe raised a few $1 million, maybe has a $50 million market cap or whatever, and looked and said like, okay, we're supposed to buy this thing for $50 million, right? Like it just is nonsensical. Like, no one believes that this thing is worth $50 million. Like it's just a speculative, premium that's not sustainable. And so then the only counter to that is, okay, but we also have a token, and that token also has a speculative premium. And so what we're going to do is we're going to print more of those tokens and do like a token swap. And that can potentially work. But oftentimes the project that's acquiring this early stage project, there's like a dislocation in terms of like what that speculative premium is. And so it's, like Aave turning up and being like, hey, I'm going to buy this protocol for $100 million. And it's like, wait, what are you buying? Right. Like, and I don't even need to name the protocol. You could just say any protocol. It doesn't matter. Like it's not worth $100 million. There's no way. So you want to print $100 million worth of Aave to go out and buy this thing. Like we can build it ourselves for that is the answer. I think that most communities would say. So yeah, it's a challenge, I think, for M&A, unfortunately, just due to valuation nonsense.
So if M&A doesn't happen right now at the bottom, at what feels like maybe the bottom of the market or near the bottom, whatever you want to call it,
it's never happening. Yeah,
then it doesn't happen.
This is the time, right? Like, you need peak fear, I think, to tamp down the speculative premium that you have for these smaller early stage projects.
Yeah. I mean, there are acqui-hires and that happens. And
it does.
Sometimes for like really high, who was that guy? It was the Jeff Bezos guy. He's like, he had like a diaper company.
Oh yeah. It was like $2 billion or something like that. Yeah.
$2 billion acqui-hire or something. Yeah. So, I mean, that does happen even for, spectacular teams.
I think if you've got enough
I don't think
scale,
that's really what we're talking about.
No, I mean, we're not, but like if you've got enough scale, and I mean, the whole point of that company was like, it was built on holacracy or, whatever. So like that, so even that is like, you pay $2 billion for holacracy. Like you could probably get a consultant to come in and, help you with that. But anyway,
this is, maybe you think this is relevant or interesting. Maybe you don't think it is, but like that speculative premium being applied to tokens, there's something that's very different that happens like at a protocol. The way that like your equity or token base is decided is like there's some tokens are more fungible than equity. Like if you consider equity a form of currency that you can buy certain things with, you can really buy other companies or people, right? Like human capital. That's what you could spend that currency on. So like when you're doing your cap table at the beginning of a company, you like divide it up and there's none left over, right? There's just like, okay, it's like the founders, the employees, and then like the investors, right? And then at each round, you like issue more equity. But with tokens, it's different. Like when you look at the initial token distribution, it's like, okay, this is for the founders, this is the devs, this is for the community. And this is just this chunk that's for nobody, but it's what we're going to use to like buy shit with. And it's just it's very different because those tokens are like more fungible you can't buy anything. You couldn't go to like CVS and spend, SNX. Not that I know. Maybe that's in the cards.
You probably can. But like, who knows?
You might.
Yeah, maybe. I don't know.
But like, you can accept more stuff. You can buy more things, right? Like it's much more common to accept payment in tokens. I wonder if that has an impact.
So I think I've got a couple of thoughts there. I think, I don't want to blame all of this on like the ERC20 standard, right? But like there was this idea of like, you only get to make a certain amount of tokens, right? Which is not true for equity. Equity has the, like in a business, you can print more tokens, right? Print more equity, right? And so you don't need to have this undifferentiated pool of value, because people understand the concept that when you go out and do another round, you make more equity and then you sell it, right? Everyone else gets diluted. In crypto, people are like, whoa. We do not accept dilution. Scam, exactly. Like, I want to know how many tokens there are, and it can never change, right? And it realistically goes back to like Bitcoin days, right? Like, this is a meme that came from like Bitcoin. Like, there's a fixed supply. Yes, there's emissions, but like, you can never print more Bitcoin. If you print more Bitcoin, the whole thing is just obliterated, right? And so like that, like kind of pervasive thing, like got kind of forked into the ERC20 standard, right? Like it was included as a concept that, okay, it's day one, you're doing a project. How many tokens do you have? 100 million, a billion. And like, we all know that's not like, what does that even mean? Like they're divisible to 18 decimal places. Like you might as well have one, like, or like, it just doesn't matter, right? Unit bias notwithstanding, we've learned that lesson, right? And so I think like that is the immediate reason why I think you have this weird idea of like, we have to have an undifferentiated pool, because there's this meme of like, everyone wants to know how many tokens there will be for the rest of time until the heat death of the universe. And if there's one more token than that, I'm out, right? And so like, you know, when Synthetix went, okay, hey, everyone, we've got 100 million tokens, but actually we're going to create this inflationary supply and increase the supply. Like, most people at that point, thankfully, didn't care, because like the FDV of Synthetix was like $3 million and everyone was already out, right? But if you tried to do something like that today, right, it would be very, very hard. I think you get a lot of pushback. So I think that's the primary reason why we see that weird dynamic of like, you have to print extra equity, whatever. And like, even in theory, who is it? AMC is going through this. Like, there is a cap on equity that can be printed typically, right? It's in like a corporate charter that requires token holder voting, right, to unlock. So like, even then, I think there's like a fixed supply-ish, but it can be changed or whatever, but it's just not as strong of a meme. So that's the first thing. The second thing I think is, most equity doesn't trade on public liquid markets, right? So it's not as fungible with dollars as, you know, so as soon as you have every single shitcoin has a Uniswap pool, well, it feels much more like a dollar than, you know, some early stage startup that just raised a seed round. Like, who's out there buying the equity? Like, it just doesn't happen.
Yeah. I think a lot of it actually comes down to the early stage liquidity, because it actually kind of flips in your head. Like, one thing that I've noticed that is like totally backwards in crypto, and I have a lot of mixed feelings about it, is this idea that you should like get rewarded for being first, and that reward should continue to like accrue to you disproportionately, which is like the opposite in equity, right? You start with this like small pool that like nobody cares about, and then you kind of grow it, and like, you're okay with like diluting yourself because you have a smaller part of a much bigger pie. And I've noticed that that's like totally flipped in crypto. And it's like, well, I was here first, so like, what are you going to give me for sticking around?
Yeah,
and
I've got 10,000 Bitcoins, and like that, you can pry them out of my cold dead hands, right? Like, that's it. So yeah,
it's interesting. And I wonder if like part of that is the liquidity at such an early stage, because, you know, one thing that I've heard, which just literally makes me laugh, is like, well, you don't want to get front run by the DAO, you know, issuing more tokens. And it's like, that is so backwards.
Yeah.
That is so backwards.
Yeah.
You know, so
look, I think there's a lot of things, you know, everything on some level is path dependent, right? And so weird, dumb decisions that were made by early crypto participants, like even going all the way back to like 2009, like weird, dumb stuff that happened in Bitcoin, just arbitrarily, like some arbitrary decision that was made. You know, maybe Satoshi woke up and didn't have a coffee that morning and was like, you know, I'm going to write this instead of that, right? And like that, like one decision like sends you off on this like tangent that like no one can anticipate what the impact of that would be 12 years later, 13 years later, right? But like, there is still the ability, like nothing is like purely path dependent, right? You can still find your way back to the other reality, you know, it just might take time, right? And so, you know, I think that as the market becomes more efficient, as experimentation happens, things that are more efficient will do better, right? And, you know, more participants means more experimentation, which means like, oh, now we're doing this experiment where we don't have a fixed supply. Like Synthetix was one of the first to do this, right? We were like, we're not going to have a fixed supply token. We're going to have inflation. We're about to shut off inflation, but that's a different story.
I know.
You know, so, well, I say that. I'm about to propose it. They'll probably tell me to
shove it.
Yeah, exactly. Yeah.
You're too benevolent. That's the
I
thing.
know. Yeah.
Kain,
I've
what's the reason for that? Can you just what's the reason for shutting off inflation? And what are the, maybe talking about the path dependencies, what are the second order impacts of shutting off inflation?
So one of the fun things about Synthetix is we understand, I think, as a community, and this, I think there were a lot of early people that found their way to Synthetix that just liked the way that the early community thought about things. Is we're in a lower information environment, right? So you can sit there and you can speculate about what the impact of anything is going to be, but nothing is as good as empirical evidence, right? So let's do the thing, ideally in a small scale, right? And we try not to walk through one-way doors, but do it at a small scale and see if you die, right? Eat a tiny little bit of that mushroom and see if you live, or whatever, right? And if it's super poisonous, you probably die, but you accept that's the risk of life, right? And so I think that this idea of shutting off inflation, people within the Synthetix community and the overall Synthetix community is very open to experimentation. And we're coming up on this very meme number, which is what kind of triggered it for me. There's 300 million tokens about to be issued. I think we're at 292 or something like that, right? So there's 8 million tokens left. We started off with 100 million. Then we changed the inflationary schedule, and we've gone back and forth and had more or less inflation, whatever. But 300, the Spartans, et cetera. There's this meme thing about somehow we ended up at 300 million tokens, which no one expected. And here we are, right? And the reality is, why can we do it today versus 6 months ago? Because we actually have fee revenue accruing now for the first time. So we could maybe get away with it. Is it too early? Maybe, right? But, Synthetix and the Synthetix community has never kind of shied away from doing things that are a bit high risk. In worst case, it is too early and there's, some issue, whatever, then, we can fix that problem, right? It's not an unfixable problem.
Do you think, and Jason, I have a bunch of questions for you specifically on Synthetix. I know you've got a big upgrade that's coming down the pike, but I got two more questions before we just move on there. Do you think there's kind of a game theory thing here in terms of shutting off rewards kind of for inflation? Because there was a proposal that almost passed with Compound, right? And to your point, right, they kicked off yield farming, right, in DeFi summer, and there was a proposal that got really, really close, right, to shut off rewards. And to your point about path dependency, I'm maybe if they had shut it off, it would have been well, if Compound shut it off, I can shut it off. Do you think it's just a game musical chairs? Everyone's just waiting to be finally we can shut these things off?
Yeah, the Overton window of what's acceptable in crypto is typically very small, right? Because it's still a very small community. And so it takes some crazy person doing some crazy thing, right, to kind of open that up, right, and say oh, this is a thing that we can do now, right? And I think the reason, particularly if you go back and look at some of the things that were done and some of the mimetic rules that and dogmatic things that kind of emerged in the ICO mania, was that in an ICO you had a 6-week window from announcing your thing to raising all the money, right? It was insane. It was nothing the world has ever seen, right? And so if you made one wrong move, you went from this reality where you could raise millions or tens of millions of dollars, billions of dollars in the case of some projects, to nothing, right? It was a very binary outcome. You set one foot wrong and it's over, right? The community would abandon you and move on to the next thing, because it was just this rapid fire cycle, right? And so that created this very rigid view of what is acceptable. Because, you would have a conversation with an investor and they'd be okay, so what are you doing with this? And you'd be we're doing this. And they'd be I'm out. And that was it. It was done. It was not a conversation. It was just sorry, I got to call in 15 minutes for the next crazy scheme, right? And so people were kind of forced into this kind of view of, okay, we have to do these things. But then I think, and DeFi summer was similar, right? If you wanted a yield farm and you wanted people to go into it, you needed to use staking rewards.sol. If you wrote your own contract, even if it was better, people would be whoa, I don't trust this. And they would go on to the next thing, right? So when things are moving quickly, people kind of, hew to whatever is the accepted, approach to things. And I do think that has constrained our ability to experiment and iterate and test things. But during bear markets, the pressure is kind of there to do things, right? You kind of have to try new things. So I think during bear markets, you get a lot more experimentation. Whereas in a bull market, it's just about do the thing that everyone expects you to do as quickly as possible and take advantage of, this crazy market momentum.
I've got one more question about fees before we close this topic. One thing that I've noticed and maybe push back on a little bit is I think there's a difference between, to what you were saying, like proving that a protocol can earn fees, right? And that there's actual value and it's not just based on, inflationary, like just giving out rewards, versus actually returning capital to token holders. And I've noticed that people are like mixing those two concepts up, right? Like to your point, right? In the beginning, you like subsidize your growth, like do whatever you got to do to like get yourself on the map. Then you have to prove like a provable revenue strategy and the ability to generate profit. You probably don't have to extract it yet, but you have to prove that you like can do it. And then eventually, right, this is like the life cycle of a company. Then you return capital to shareholders, or in our case, token holders. And I've noticed that people are like conflating these two things. Like, yes, like earn fees so you can give me, the token holder, back the reward. And I'm like, that is not, I just don't think that that's what should be happening at this early stage, right? You should be like protocols, right? It should be taking that revenue and putting it in some form of treasury and like reinvesting it. This is a capital compounding problem, not a, juiced returns problem. What do you think about that?
I think, again, that's kind of another meme, right? Of like, there's a lot of entitlement in crypto, right? And so the entitlement is like, whoa, like, why would I allow money that could go to me to go to someone else? Like, that's not okay, right? And so like, there's this like very rigid view of like, no, what could Uniswap have to do with? And also, I think a lot of people look at large treasuries and they say, why would I give, that multi-billion-dollar DAO treasury more money when I could have it, right? Like that's the other side of the coin as well, I think. And I think the final thing of maybe where this emerged from was the idea that like DAOs don't need money. They're efficient, right? They're autonomous. Like, why would a DAO need money? Why do they need a treasury? Like, why do they need to do things, right? Like the early days of like pure DAOist like view was like, it's just going to be some code that runs and like people will kind of be hanging around looking at it, but like no one needs to do anything, right? And I think we've realized that that's actually not the case. So I think there is a tension there between people selfishly wanting the yield as soon as possible, right? Like, oh, there's fees. I want those fees. I'm a token holder. I've got, 100th% of the supply. I want 100th% of the fees generated today, right? But to your point, is that the best idea? That's why we have governance, I guess, right? To debate these things.
Right. Sorry, I know I said this was the last question. Fees.
Yeah.
How do you think fees end up getting implemented? Because, right, there's this very rich history in TradFi of like people not liking to pay fees that are upfront. So what they do is like everyone's still got to make their money, so they put it in the background, right? Like probably the most relevant part of this discussion is like MEV. But I'd be curious to like get your sense of like how you view that happening. Right? Like, do you think people are just going to be okay with paying fees, or they're going to be like, hey, we demand lower fees, and then you say, okay, well, hey, we'll take down your trading fees or whatever it is, but like we'll find this other kind of sneaky way. Like, how do you see fees getting implemented?
Yeah, I mean, payment for order flow is probably the best example of this, right? Like, okay, you can trade for free, but and I mean, Matt Levine from Bloomberg has talked about this like a million times, right? That like actually that is better for everyone, right? It is a better situation, but it just feels like there's something like, to your point, like sneaky thing going on in the background, right? It just feels like, oh, this doesn't look good. But the reality is that like uninformed order flow is valuable, right? Like that's a valuable thing, right? Like, because, and Synthetix has struggled with this, right? Like this is actually, you asked about the direct integration SIP, right? And why we're doing that. The direct integration SIP is kind of the equivalent of payment for order flow, right? It's like the DeFi equivalent of that. So we're basically saying to Curve, we want your order flow, right? We know that it's uninformed arbitrage, right? We know that it's undifferentiated people trading through Curve, and they're doing something else, and we're just facilitating that. It's not someone who is sitting on Binance, trying to manipulate an Oracle update by like dumping the price, and then it's not someone who knows that a token is about to collapse because there's been some kind of hack or something like that, and it's trying to like take advantage of it. Typically it's 99% of it is just uninformed arbitrage flow, right? Moving between exchanges and AMMs and all kinds of stuff. So we want that flow. So how do we pay for that order flow? We pay for it with lower fees. And we say, we're going to build a direct integration into Curve and give you lower fees if you accommodate this new route, right? And that is a really good way of kind of generating more volume, because it's valuable to us to have uninformed order flow, right? And not have like adverse selection.
Jason's never going to invite me back on this podcast again if I keep so Jason,
no, I just want to know, like, Kain, I've been spending a lot of time in like the Maker and like just thinking about like Hasu and like, his proposal and Rune and like his end game. And I actually do want to get your take on what's going on with Maker, but not yet. I want to get I'd love to just hear like, what is your end game for Synthetix? Like, what is the vision for Synthetix?
I think my vision versus like what the vision is, sometimes gets conflated, right? Like it is.
I want to hear your vision, not the communities, not the forums. Your vision.
Yeah. So I think my vision is I want Synthetix to be the thing that I've always wanted for Synthetix is to be self-sustaining, right? So that means that we need to get to a point where the volume and transaction activity that's happening is sustainable, right? That we don't have adverse selection, we don't have the risk of front running, and all of that stuff. And so the vast majority of the work of Synthetix over the last like 3 years has been like front running mitigation, right? Like adverse selection mitigation and trying to prevent people attacking the exchange, right? Because you've got this open system that anyone can come and trade against, and so people are constantly attacking it. Right. And we've gotten more and more sophisticated at kind of preventing those sorts of attacks, and you're trying to minimize the damage of them. But right now, it's still like an arms race that is ongoing. Right. And so you can't just say like, oh, the contracts are there, see you later. Right. Like within 6 months, someone would develop some new scheme to like try and extract value from the contracts that would be significantly bad. Like it would be very detrimental. Right. I would imagine. Over time, obviously that risk goes down because we've chipped away at the advantage. But like that is just a very real thing that is ongoing with Synthetix. So until we get to a point where we're like, okay, this feels like we've got a long-term solution that is sustainable, like a sustainable equilibrium, then you have to keep working on it, right? So that's the first thing. I think the second thing is to get to a point where the community and particularly stakers are sufficiently incentivized to continue to like maintain the protocol, right? That like, it's generating fees, it's working, and, there's a lot of distributed parties that have a significant incentive in keeping the thing alive, right? At the moment, I think if you kind of switched off the efforts of the core contributors, let's say, right? And the DAO stopped paying them, would people turn up and do things? Like, are the incentives aligned for them to kind of continue to do things? Probably not. At a certain point, though, when the yield is high enough from fees and transactions, and when the risk-adjusted adverse selection issues are dealt with, people I think will just continue to work on it because they're making money from it, and it becomes more like a genuine open source project, right? Where like there's people who are reliant on it as a service and will contribute to it. So for me, that's my vision, is like to get to a point where like across all dimensions, Synthetix is sustainable. And it's never, I don't believe in this idea of like, it just gets to like a stable point and then it stops, right? And then like the contracts are done. And, I think there's always going to be ongoing maintenance, but the key is to make sure that ongoing maintenance is properly incentivized long-term. So you don't need to keep pushing it to keep that maintenance and keep the momentum going.
There's an interesting dichotomy between like, I hate the term Web 2 and Web 3 actually, but I will use it here, which is like Web 2 founders and Web 3 founders, which is what's the end state for Web 2 founder? It's like, I want to IPO or I want to get a big exit. And like when you talk to a lot of Web 3, like, I don't know, crypto native founders, oftentimes the end state, the end game, the end goal is self-sustaining. Why do you think that is? Like, why is that your end state?
Because if you look at a Web 2 founder, most of the time they've created some, multi-tier equity structure where they retain control, them and their descendants retain control of this thing in perpetuity, right? And realistically, that's not sustainable. And I think Web 3 people fundamentally believe, like at some point I will die. Some point in the future I will die, right? So if Synthetix is reliant on me being alive, that is not sustainable. Right. And that's a very like philosophical way to approach the problem. But like, if we don't have the right incentives in place such that someone steps up or ideally a lot of people step up to continue to maintain this project and maintain its value and continue to push it forward in absence of me being here, then it's not really sustainable. Like, we've seen this happen in a lot of Web2 companies. The founder leader leaves and the thing falls over because it was never really sustainable. It just was relying on the efforts of that one person to keep pushing it forward. So I think that is one of the reasons why, like, a lot of us are, a lot of the early crypto people are, very like crypto anarchist and believe that you should have like distributed control and you should have like a single hierarchical, tree of decision making, et cetera. And so in that environment, the only way that you can have something that's sustainable is you have the right incentives to like keep the thing going long term in absence of this founder leader idea.
Long term, to become self-sustaining, you obviously have to be set up as a DAO. But I'm curious if do you think you would be more or less successful, like up until this point, if you were not set up as a DAO? If you were just a centralized company, you were the CEO, you could execute really quickly, you could hire the people that you wanted to hire, you could ship the products that you wanted to ship. Would you be more or less successful up until this point if you were not a DAO?
Far less successful. And this is the thing that people miss, right? Who is perpetuating this myth of these magical geniuses that know everything, that have like this game plan or whatever, right? Fucking VCs and the people themselves, right?
Yeah.
Like, like there is no such thing as like this magical like, okay, Vitalik notwithstanding, right? Like, and even Vitalik isn't sitting there saying like, do everything that I say, right? Most of the things that Vitalik says tend to be pretty right, like over a long enough time horizon. But like, I guarantee you that even Vitalik short term has like, we know that, right? Like Vitalik got up there, multiple times and told us like some new thing was going to be the best thing ever. And if he had like unilateral control to like push forward every single change and the community just accepted every single thing and there was no pushback from engineers or whatever, we would have gone down a very different path and probably would be much further away from the scaling goals that we have for Ethereum, right? The same is true for every single project and every, if literally we listen to everything that Rune said, like I love Rune, but like he has some dumb ideas sometimes, right? Like, and so do I. Like, so you need checks and balances, right? And I think what we have in a Web2 company in terms of checks and balances is very weak, right? And so we have this survivorship bias where you have a whole bunch of companies with single leaders, very hierarchical, and like 10 of them survive. And we go, oh my God, look at these 10 magical creatures that have come down to like save us from ourselves or whatever, right? But like the other 1,000 that made separate random dumb decisions and died, we don't care about them, right? So when we look at Web3 and think, okay, how do we not fall prey to this idea of like a magical leader that knows everything, omnipotent or whatever? The answer is like you put structures in place to make sure that governance is much more decentralized. And the reality is that decentralized decision making, while it might be slower, is much more effective. Like that is unequivocal for me. Like I think DAOs and genuinely decentralized DAOs will outcompete other organizations and other forms of coordination over the next like 10 to 20 years. And in hindsight, we'll look back and be like, wow, that was so obvious. Like who thought that like Adam Newman was the fucking guy that we should be giving, billions? Like, why are we giving that guy unilateral control over like tens of billions of dollars, right? Like, no, like it's just dumb, right? It's dumb. And it's a meme that has been perpetuated by VCs and the founders themselves.
Yeah. Do you think this will be the case for all companies? Like you think DAOs will eventually, in all industries, get bigger than centralized companies, or you think it's specific to DeFi?
I think, human coordination is human coordination, right? And like, corporations as a form of coordination have had a very good run, right? But everything evolves. And when you look back 50 years and look forward 50 years, reality looks very different oftentimes, right? Like, as we kind of progress. And so I think that the idea that you have this new coordination mechanism, right, that exists, this new technology is not going to transform how we coordinate ourselves is very crazy to me, right? Like obviously it will. In the same way that like people are like, oh, the internet, it's interesting, but I don't think it's going to have a huge impact on anyone's lives, right? Like there are a lot of people who, because they just don't have the like vision to like, and it's not like you are sitting there saying, I know exactly how this is going to play out. Like I know how the internet in, 1990 is going to play out in 20. No one knows, right? But like you can sit there and say, I don't know, but I know that it's going to be fucking weird. And stuff's going to happen, right? And I think that that's the same thing for crypto. Like, I don't know if DAOs are going to look like what they look like today. It would be weird if they did, but there's no question that this technology is going to unseat the kind of technology that we have in place today.
Kain, our analysts are going to kill us if we don't ask you at least some technical questions about the V3 upgrade, right?
Sure.
So some of the features, they're literally going to get murdered. So some of the features there are multi-collateral staking, customizable debt positions, permissionless synths. So maybe if you want to touch on some of those, but like just from a high level, like what is V3? What are some of the big changes that folks should be expecting?
Yeah, so I think V3 is our chance to rebuild the protocol from scratch, taking into account all of the things that we have learned over the last, 4.5, 5 years, right? And so, and even there were just things that were not even contemplated, right? Like from like a technical perspective, right? This idea of like continuous time functions, like they existed, but there were no implementations in Solidity back then, right? And even like proxy architecture and like there's so many things where we just had to cobble together some solution to make it work at the time, back in 2018 or even earlier in the case of some of the like Haven code. And so we've learned a whole bunch of things, and the industry has gotten much more sophisticated. There's a lot more kind of design and mechanism work that's happened, and we have kind of looked at all of the functional components. So Synthetix requires claiming of fees. Okay, great. So back in the day, we were like, what if you claim the fees once a week and you have to do this weird convoluted thing and it was super expensive, whatever. And now today, like we have a mechanism for claiming fees that, in continuous time that like most protocols use. And it's just the understood way to do this thing, right? But we can't slice out that little bit of code and replace it because, the overall thing is just so complex, right? So we basically said, okay, let's take all of the functional components, look at what the, state of the art is in terms of how you implement them today on chain, and design a system around those components. So it's doing the same thing in just a much more effective way, basically. And then there's some things where we're like, that was a dumb idea. Let's remove it and replace it with a better idea.
What do you think about? So one of the things that I think you have to keep in mind, right, especially as a DeFi founder today, right, is regulation, especially US based regulation. Be curious, to get your thought on like for synths. Do you expect to just be able to? Because one of the things that I think you're introducing as well is like permissionless synths. So the ability to create something like an equity, right, like an instrument that mimics like Tesla stock or Apple or something like that. I think US regulators have been not super kindly predisposed to. So I'd be curious to get your thoughts about just that whole interaction.
Yeah, I mean, I think if you go back 3 weeks ago or whatever, right? Most DeFi founders would say that like we weren't in an environment where something like OFAC sanctions were super likely, right? Or even like some other regulatory body like really like bringing the hammer down, right? It's one thing to like go after some fraudulent actors and punish them and make them disgorge profits or whatever, but we hadn't really seen like a lot of aggressive behavior towards what I would call like good actors in the space, right? Like people that were like genuinely, trying to build things that had value for their communities and society. I think that has shifted a little bit, right? So previously I would have been like, well, Synthetix is sufficiently decentralized that even if a regulator might not like the idea of synthetic equities, if the community decides to deploy a permissionless contract to do it, right, that's fine. But I would say today the kind of trade-off space there has shifted a little bit, right? Where I would say like probably you shouldn't do that, right? Like the community probably shouldn't do that. Now, okay, you create permissionless synths, right? And same way that you create like permissionless Uniswap pools, and you can't really stop people. But what that's forced Uniswap to do, as like Uniswap Labs, I guess, right? Like predominantly is like blacklist a bunch of assets, right? And remove them from front ends and things like that. So that's not something that Synthetix as a community has typically done. But I just think we need to be much more mindful, given the current environment than we were. So I think you would have a hard time convincing the council, who are ultimately the representatives of token holders, right? I think you'd have a hard time convincing them to create, synthetic equities.
How about, I know another idea that you've talked a lot about, right, is liquidity as a service. Can you walk us through like what that means for you specifically?
Yeah, there's a lot of people that are trying to experiment with this, right? They're like protocol owned liquidity and
Right.
different things like that. And so I think we unfortunately a lot of the projects that were experimenting with that stuff tacked on weird Ponzi's, which kind of created like a little bit of like a weird sense for people that like maybe it was not like as legitimate, of an idea. But I think that the reality is that like liquidity is one of the most critical things in DeFi, right? And so if you can facilitate more efficient trading, people will pay for that. And we're seeing that with like atomic swaps, right? So like Synthetix is this like liquidity as a service that is injected into the middle of like an arbitrage trade, right? That just makes that trade more efficient, right? And people are willing to pay for that because they get a better fill, et cetera. It's kind of like that payment for order flow stuff that we're talking about as well. So I do think that like a lot of what we're doing in DeFi is just about provisioning liquidity, right? And then the question is like, how do you pay for it, and who pays for it, who benefits, et cetera.
I have whenever you're looking at something that's as complicated as provisioning liquidity, I think it would be an interesting exercise for listeners to like, if you had to sum that up and describe Synthetix in one sentence for your business model, how would you do that? Because I've thought about this for Blockworks too.
I like, this is not the first time that I've been presented, like even like, in the community, right? Like people turn up and they're like, what do we do? And I'm like, I don't know. Like we do a bunch of random stuff, right? So like,
inspiring.
Yeah, exactly. I know, right? Like I think ultimately like Synthetix is, and I've said this before many times, right? Synthetix is less about being a specific solution to a specific problem as it is like a generalized like solution machine, if that makes sense, right? Like what we're, we see opportunities and we try and solve whatever the challenges are for like taking advantage of those opportunities. So like atomic swaps is a good example of that, right? Like that was not part of the core Synthetix, mission, right? Like it was really like we wanted to build an exchange where you could trade synthetic derivatives of things, whatever. And then just the market shifted, AMMs became a big deal, Curve and stable swaps and all that stuff became a big deal. And we just saw this market opportunity where like, wait, if you have two pools that are, super liquid, but are disconnected, right? And siloed, if you could bridge those two pools, you could, capture a lot of value, right? And so, literally we went out and tried to solve that. And we've still, we had like a bunch of smart people, Andre and Anton from 1inch and, a bunch of people trying to solve this thing. Right. And, it turns out it's a really hard problem to solve, to do it in a way that's like not front runnable and not exploitable. So I kind of think like Synthetix is about just trying to solve hard problems, not about like any specific solution.
I guess just the last question. This also comes from our analyst. You kind of talked about it with the decision to go off the inflationary schedule. And the way you maybe describe that is like, not to put words in your mouth, but it's not a bet the kitchen sink type thing, but it's like definitely a very important decision that I'm sure you've chewed over quite a bit. Can you again kind of like sum up for us, like what is the reasoning behind moving off the inflationary model? Like what are some of the risks that you see in your mind, and what do you hope to gain, right? Like when you come out of the other side, like not being dependent on that, what's the, other than the 300 meme, which I'm sure you can rip like great Leonidas memes all day long, but like what's Valhalla?
So we actually, and this got less attention, but we actually tried the alternative, right? We actually tried to increase the inflation rate, right? To see if it would have an impact on staking. I had this idea that like if you increased inflation significantly, you would get a higher staking rate. Now, staking in Synthetix is kind of critical, particularly in V2X in the current system. In V3, it's less critical, but in V2X, it's critical that people stake SNX to provide liquidity. And we were, pretty regularly trading above peg, right? We're having a hard time like getting enough synths into the circulation to kind of, meet demand, right? And so the idea was, well, we're only seeing about 65% of SNX staked, right? Back at its peak, in 2019, it was like 85 or 90%, something like that, right? And that was with a higher inflation rate. So we're like, okay, fee yield is not sufficient right now. What if we increase the inflation rate? And we did, and really didn't move. Now, my argument was we didn't give it enough time, right? And that, like, you know, maybe, which is that's always my argument, right? That, like, you just need more time. But, like, you know, maybe after 6 months or 12 months of higher inflation, maybe it would have moved the dial. But at a certain point, you need to say, well, look, we've experimented with this and it didn't work, right? So we started decreasing the inflation rate about like 5 or 6 weeks ago or whatever, in response to the fact that, like, this number that we were trying to get in, like the staking percentage, just didn't move, right? And so my theory is, well, okay, we tried it in that direction. Let's try it in the other direction. Like, if incentives from staking are not, like the inflationary rewards are not sufficient to move the dial, what if we remove it? Will people keep staking? And if staking rates drop, then I think we'll need to, like, assess that. But, you know, if we end up in a place where like 50% of SNX is still staked just for the fee yield, and people have an expectation like future fee yield will go up, then, like, theoretically that should create like a positive cycle, because you've got less, SNX kind of being printed every week. And there's a lot of people, I think, out there who sell their inflation, right? So it is, even though inflation is locked, there's a lot of people with unlocked SNX that can, okay, I got 100 SNX. Well, I'm going to go and hedge my exposure for that year by selling 100 spot SNX today, right? And so you remove that constant selling pressure, even if it's only 20% of inflation or whatever that's being sold every week. You remove that, and I think that will have a positive feedback loop in terms of, kind of price discovery and realigning things. So that's the overall reasoning, but also the 300 meme.
Also, always do it for the meme.
Yeah, exactly.
Ken, I want to think about wrapping just with two topics that are not related to Synthetix. One is, I want to get your take on Maker and like Hasu and Rune and just everything that's happening there. The other is, I want to get your take on protocol specific stables, like Aave rolling out stables. I'm curious.
Yeah.
I mean, you can start. Where do you want to start?
Look, let me address the stablecoin thing first, right?
Yeah.
Like, this speaks, I think, to Michael's point earlier about like returning money to investors versus like reinvesting it, right? Like, is Aave, whatever Aave is, right, the best thing that Aave token holders could be giving capital to, like the best entity, the best, whatever thing to be investing in, right? Like, because you get to a point where people are building empires, right? They're like, oh, stablecoins sound fun. Like, why don't we do that, right? Or maybe we'll build a social network or whatever, right? So if you are giving money, like, yes, Stani is amazing. And yes, the Aave community is amazing. They've done an incredible job over the last 5 years. But like, am I giving them my marginal dollar to go and build something because I think this is a great idea? Like, that's not how we solve investment, right? Like, we find a small team that's got a very clear idea of what they want to do, and we give them the money and say, go out and do this thing, right? And focus on it. So in that sense, like, returning funds to token holders so that you don't have this giant pool of capital where you're like, oh, what are we doing today? I guess we're going to, whatever. Right. So that's what I worry. And the second thing is, I think people have forgotten that stable coins are hard. Like, and this speaks to Maker, right? Like, why did they forget this? Because Maker just jammed a bunch of USDC into like a wrapper contract and called it a day, right? Like, and I say that like in the meanest possible way because I've been against this the entire time. But like, it made people have this false sense of like, oh, it's not that hard to have a decentralized stablecoin. But UST, look at the the counterpoint, right? Like, it's really hard to build a stable coin that is sustainable. Doesn't matter how much capital you have.
I would we were doing an analyst call, like our Q3 analyst call, and there was a prominent like Fin Twitter listening, and he DM'd me and he said they were talking about the decentralized, like these stable coins like Go and the Curve one, and he was like, do you realize that your analysts are just describing private banknotes? And I had to sit and think about that. And I was like, shit, that is literally exactly right. From like the Wildcat banking days, it's like each bank would be like, hey, what do I have? I have this, there's a whole bunch of assets here.
Yeah.
I can issue $1 against them. I can do my own little private fractional reserve banking system. And like that worked horrendously. So
it's funny. Like I try to reread this like once a year, Hayek's Denationalization of Money, right? Where he talks about this idea of like being able to like issue, your own currency, right? Like having like a market driven version of currency rather than like having it like be centralized into a central bank or whatever. And I think the interesting thing about it is that like he didn't contemplate the technology. So like obviously he was like, well, the only entity that could do that would be a bank, right? Like, but now actually no, like we have the technology that anyone can print their own money, and it is a much more like market-driven thing. The problem is that like not everyone should print their own money, right? And even more importantly, it's one thing for Aave to print Aave tokens, right, as like a form of equity and use them to create incentives or whatever. It's another thing for Aave to like create their own dollars, right? Like that's like a different thing. So, again, I think people underestimate how hard it is to manage a stablecoin. In the same way, and again, like I love Aave, but like I think Aave has already come to this conclusion that Synthetix came to, a long time ago, which is like, it's also really hard to be on like 55 different fucking networks, right? Like, if you go and deploy your code, even if it's just like, oh, we're going to dump it, like it's not as simple as just deploy the code and walk away. Like you have to maintain it. You have to deal with the people who are using it. Like it's really hard. Like, and oftentimes each marginal network is going to be net negative for the protocol. It's going to be a distraction, and so that you're already seeing them like pull up some of those deployments and be like, actually, we're going to shut this thing down. It's not worth it, right? So, but it's good experimentation. Someone needs to do that experiment. Thankfully, Aave did it for us. And they've told us that maybe it's a bad idea to deploy into every possible EVM compatible chain as quickly as possible. But to come back to the Maker question, I actually spoke to Rune for the first time in a little while last week. And, I think everyone was caught by surprise by this Tornado Cash thing, right? Like, okay, we sit here and, we talk about all this cypherpunk stuff and, anti-status stuff and censorship resistance, whatever. I really don't think, in the same way that like everyone was a bit caught by surprise by like the aggressiveness of the SEC, over the last 18 months, I think we all kind of thought we had a bit more time before like we genuinely had state actors coming after us, right? And I think that was Maker's thesis, realistically, right? They're like, oh, this is not going to be a problem. Like USDC is fine, it's not like an existential threat, et cetera. And now I think we're seeing that like actually it is, right? Like they have the ability to block token addresses. They are not just willing to do it, but like they're eager to do it, right? And with the right incentives, Circle is eager to, like they will over comply, right? Like OFAC didn't come to them and be like, hey, go and block all these addresses, as far as we know, right? They looked at it and said, what is the biggest de-risking thing that we can do? Block everything, right? And just like shut down those addresses. And the idea of like stranding end user funds, right? And like not insignificant amounts of money in these contracts as like an over compliance thing is like petrifying to Maker, as well it should be, right? Like, what is the threshold that would get some entity, like doesn't have to be OFAC, could be, some entity in Europe or like, who knows, right? It could be anything, but like, we don't know what the reaction of Circle would be. I mean, making a call to block the Maker addresses as a compliance measure would be pretty huge, right? Because it would almost invalidate USDC as like a stable coin, right? So that would be an existential threat. So it's definitely a level above Tornado Cash, but like, do we want to play that game, right? So I think that the reality is the Maker community made a bad call a long time ago about how to scale DAI by just dumping a bunch of USDC in there. They thought that they would have more time to get themselves out of this mess and figure it out. But I think, unfortunately, they're out of time and they're going to have to make some hard decisions about what the path forward is.
So if you were if you were the full dictator of Maker, what are you doing?
If I was the full dictator of Maker, there never would have been any USDC in DAI, right?
But knowing that there is.
Knowing that there is. If they said to me today, hey, come and be the dictator of Maker, I would absolutely shut down all paths going towards real world assets. Real world assets are not the solution here, right? Like, and I've been against them since when they were first proposed in like 2018, right? Like this idea of we're going to put, treasuries and all kinds of stuff in there. So like, I just think it's just a bad idea. As soon as you attach something to the, real world, like a smart contract to the real world and are reliant on it, that is a pressure point that anyone can leverage against you, right? And your ability to maintain censorship resistance and, avoid regulatory pressure, et cetera, just is gone, right? It's the same reason why I advocate for DAOs to not have entities, right? As soon as you've got an entity, even if it's like a Cayman's foundation or a Swiss foundation or whatever, as soon as you have one entity that has some control over the protocol, that is a pressure point that people can leverage to try and impact the protocol.
So your perfect collateral, like you think the collateral of DAI should just be Bitcoin and ETH?
I mean, this is the problem, right? Like that's not the solution. Yeah. Like we've seen that, right? Like that doesn't work, right? Yeah. Okay, so is there another solution? And I like my argument at the time when this was happening was maybe you threw up your hands a little too soon, right? Yeah. Like Synthetix has dealt with all kinds of issues of supply constraints or whatever, and we've chosen ideologically to not deal with those supply constraints by using USDC. We could have, like Synthetix would probably have like $2 or $3 billion worth of supply, right? If we had decided a year ago or 18 months ago to just dump USDC, and like no question, right? Like it makes sense. Like SUSD is used to farm a bunch of things. People want more of it. Like USDC would have just flowed in, and like the majority of synths would be backed by USDC right now if we'd make that call. Like I think that's pretty obvious. So yeah, that's my view, is that like it's fruit from the poison tree. As soon as you take that first bite, game over, because it's going to be hard to wean yourself off it.
Kain, this is
actually one of the biggest.
Yeah.
You get.
I was gonna wrap. Kain, I know it's been an hour.
Yeah, you wrap.
I think we could do this for 3 more hours, but this is Thanks for waking up early and doing this with us. It's
my pleasure.
Really enjoyable conversation.
Definitely need another coffee though. Hitting the end.
Another green juice, another espresso. Yeah.
Exactly. But it's been super fun. I think like honestly, like a lot of these topics are topics that don't necessarily get raised on like the average show, right? Like people just want to talk about like what's the roadmap look like, or whatever. I think that like most of the things we talked about early on are much more important than like specific aspects of any one project, right? Like they're fundamental things we need to address to move forward. So
cool, man. Well, we'll do it again soon.
Thanks, guys. Appreciate it.
All right, be well.
See ya.